Welcome back to Opening Bell. Want to get you ready for the trading day. And look, the rest of the year is upon us. Dave Mazza, CEO of Roundhill Investments, is with us. And look, we saw people step in on Friday. It was a little bit of chaos last week, back and forth. We saw the VIX jump, but we ended up with somewhat of a mixed week. The Nasdaq was slightly lower while the S&P and Dow squeezed out gains. What did you think of folks stepping in, buying dips, and this action now this week ahead?
Yeah, well, it's interesting. So last week was actually one of the worst weeks that we've seen in many months, and if not years, on retail favorite stocks. So stocks that retail have actually been purchasing the most. And what we do know, right, in the context of the fact that retail has actually been the dip buyer, they weren't scared in the tariff tantrum that we saw in April and actually stepped in and bought while institutions were moving away from the market. So now we're coming into this week, which a lot is going to rest, of course, on Nvidia earnings. I think that's quite obvious. Plus, what's going on with the consumer, I think people are going to be paying even more attention to the retail earnings. And as you noted a moment ago, we finally have some delayed employment data coming out. So there's a lot to absorb in a short period of time. And at the same time, the question is, does retail still have the ability to power the market ahead, particularly if institutions are going to be skittish going forward?
So what kind of retail favorites are you talking about?
Well, it's really been kind of these major themes that we've seen, right? So AI and AI adjacent stocks, quantum computing, some of the nuclear names. These are the stocks that have really been the growth stories in the market. And investors have actually repriced them into such high levels that people are actually expecting that they would continue to grow really at obscene levels that we've seen. But the challenge is that many of these companies are not necessarily cash flow positive. And what happened is when Meta came out and sort of announced that they were going to continue to plow ahead on spending, it really has reset the market's expectations of how much capital is going to take for this AI boom to come to fruition. And in the absence of sort of the economic data and what the Fed has been saying, I think people really pulled some chips off the table in a short period of time. But on a positive side, to your note, they did come back in on Friday.
Yeah, and you said some of the laggards versus the winners. I mean, sometimes we see the dogs come back, but there is sort of this cyclical action. What do you expect going forward in the next 6 months?
Yeah, so we saw a huge reversal where actually the best performing stocks were the worst performing last week. So meaning the stocks that had the best run up in 2025 sold off the most. And so that's, to me, indicative of people selling their winners and sort of regrouping. Looking ahead, I think what to me is, of course, we have Nvidia earnings, but then the next question becomes, well, what is really the FOMC going to do? We were pricing in nearly a 90% chance of a rate cut in December. That's been knocked down significantly to less than 50%. And the fact that the bull market really has become contingent upon further rate cuts, we could argue whether we need them or not, but so much has hinged not just on these companies delivering the story, but do we continue to get favorable financial conditions? And so I actually think in the absence of a Fed rate cut, I think it sets up for kind of a challenging, murky picture heading into 2026. But it's interesting, the market seems actually now to kind of be begging for bad data to make the case for rate cuts to come a lot sooner. So we're almost getting into, if we remember a few years ago, the bad news is good news situation. And I think because so much has hinged on the fact that we know inflation has come down, but not necessarily to levels that the Fed or others would want. But really what's happening on the employment side, we've had private market data to help us with that. And until we get some clarity there, I think it's going to be in for some choppy trading.
And what's your strategy then? Are you not buying dips? Because you said, look, first of all, the likelihood now of a rate cut has been dropping for December precipitously. I mean, from 90% to 40-something% at this point. Tell me about what your strategy is. What do you buy? How do you make money? Or do you just take money off the table and take your profits?
Well, I think it's reasonable that we saw some people take some profits in the last week as we reevaluate what's going to happen on the rate cutting cycle. But it's interesting. There's still sectors that are working quite well, right? And under the radar trade, which has frustrated investors for years, is the healthcare sector. If you look at some of the stocks, including those associated with weight loss, they've done incredibly well. And in fact, they've really powered ahead. There's M&A activity there. So there's still tons of opportunities in the market. I think it makes sense to maybe get a little more defensive here, but it doesn't necessarily mean that this AI trade is over. I think we're in a period of digestion. There hasn't been a lot of catalysts in the market. We have a big one on Wednesday. And if we get kind of the all clear signal from Nvidia, especially with getting some insights into what may be happening in the super cycle that we're seeing here, then I think that helps propel the market higher because there's still a propensity for people to buy the dip, just as we saw on Friday.
Yeah, understood. When you think about the kinds of names, I mean, for example, you just saw Warren Buffett has a pretty big stake there in Google, Alphabet, right? So with that, it's worth over $4 billion. What do you think of that? Does that make you want to buy Google?
Yeah, well, I mean, we've been bullish on the Magnificent Seven for some time. We actually continue to think because of the fact that they have such high levels of free cash flow, although it's slowing a bit. At the same time, capex is increasing. It doesn't necessarily make it as easy to trade going forward. But when you see Berkshire come out and buying such a huge stake in a company like Alphabet, it tells me that there's still some underappreciated opportunity in those spaces. So I think it's going to be too easy for investors just to say, hey, I don't want anything to do with stocks going forward. I'm too concerned about what's going to happen. We got to kind of see the forest through the trees here. And again, a move of that size into Alphabet tells me that a firm like Berkshire still sees these opportunities in a company like Alphabet, which up until recently was not getting the love in the AI trade that other names were. You know, particularly we know your Metas, your Amazons from that point of view.
Look, people feel that the capex spending is coming under some scrutiny because they want to say, hey, how are you spending billions? But where is this really going there? You know, there's more, instead of euphoria or something, now there seems to be under more of the microscope. But there's still believers that these Mag 7 names have to spend big in order to accomplish. Is that where you stand?
Yeah, I think we're still going to see kind of a major growth of capex. Everything that these companies have said going forward in their projections are that they want to continue to spend. This is an arms race. And right now, you have to allocate capital to that so that you can eventually become a winner. But we are at a point where people are being more discerning of the spending and of the names. So for example, if a company has the ability to spend out of their own free cash flow and continue to grow, that makes a much cleaner case going forward, right? Look at what's happening with Oracle, was a darling of the market. Now we're hearing CDS spreads are blowing out, its bond prices are collapsing because people are concerned, how much more debt do they need to do to take on growth in the cloud space? So I do think this is where people need to be use active management in the AI side to understand sort of really where there's going to be winners and losers, because the easy gains in this trade, in our opinion, have been had. And now it's going to become really more about sort of understanding who's going to be able to win going forward. And I still think many of these names will, but we're in a period of digestion here as the market really kind of goes through and sort of starts to reprice these new catalysts that are coming.
Understood. I mean, just quickly on Nvidia, your thoughts on how you might play it?
Well, I think, look, the setup for Nvidia going into this earnings is a lot better than we've seen in previous ones, meaning although the stock has rallied sharply, it's not kind of making some of the parabolic moves that we saw heading into previous earnings season. So I think from a trading point of view, we're in a much safer space for investors to step in. At the same time, we have to know that they're expected to grow. The expectations are super high again, as always, but Nvidia has delivered time and time again in this. We have to remember they are really the beneficiaries of much of this spending, and the more hyperscalers are spending, the better off Nvidia tends to be.
Dave Mazza, CEO, Roundhill Investments. Dave, it's great to see you. Thank you so much for being on with us today.